Hello guys, welcome back to my channel. Now let's continue with the question number 2 and also let's see if we can discuss the question number 3 as well. So now let's start with question number 2 without any delay. So he says we are going to now discuss about the bit number A part in question number 2. Okay. So now NC Limited is considering purchasing a new machine to increase its production facility. Okay, now they want to purchase a new machine to increase its production facility. So then now they have some old machine kind of a thing. So at present it uses an old machine which can process 5000 units of TVs per week. Per week they are going to process 5000 units. Okay, now NC could replace it with a new machine which is product specific and can produce 15,000 units per week. It is an old machine, no, so it can process only 5000 units per week, but it's a new machine which can process up to 15,000 units per week. Oh my god, great. So that's why they're going for a new machine. Now what? New machine costs 100 crores, oh my god, and requires the working capital of 3 crores which will be released in the 5th year. At the end of 5th year, okay. Now the new machine is expected to have the salvage value of 20 crores. This salvage value means what? Residual value at the end of the year. At the end of 5th year, it is going to have the salvage value of 20 crores, right? Now, the company expects the demand for TVs to be 10,000 units per week. Though the capacity is 15,000 of new machine, the demand is only 10,000. So can you produce 15,000? 5,000 will be waste for you. So you'll only produce 10,000 units because the demand is there for only 10,000 units. Although you have the capacity of 15,000, you can't produce 15,000 because the demand is less than the capacity. So each TV sells 30,000, like sale value they have given 30,000 rupees, that is the sale value, and profit volume given 10%, which means contribution by sales is 10%. That means sales minus variable cost, if you do the contribution, it gets, which is 3,000. The contribution is itself 3,000 per unit, right? So the now company works for 52 weeks in the year. Okay, now additional fixed cost. What is this additional fixed cost, guys? Now the current machine, if we use the old machine, some X value is their fixed cost. If we replace that, then the additional costs are incurred to increase by 10 crores, he says. So for example, now 100 crores fixed cost is there for the old machine. If we replace the old machine with a new machine, now we incur 110 crores, he says. Extra 10 crores means the fixed cost is increased by 10 crores, he says. Okay, you understood, no? Now the company is subject to 40% tax rate. So tax rate is 40% and its after tax cost of capital is 20%. So the discount rate, that PV factor is there, no, that percentage 20% they have given, and the relevant rate of depreciation rate 25% for both taxation and accounts they have given depreciation rate also. The company uses the WDV method. What is WDV method, guys? It's not straight line method. There are two methods, no, straight line and WDV. So WDV, it keeps on changing. It does not the same value of depreciation is not there for every year. That is called WDV method. While doing the answer, you get to know more. And the existing machine will have no scrap value. So whatever is there, the old machine does not have scrap value or residual value, he says. Now you are required to advise whether the company should replace the old machine. For this, what we have to see, NPV, net present value, we have to calculate. If it is positive, then he can go for the replacement. If it is negative, then he should only go further with the old machine itself. So in that way, we are going to see whether he can replace the old machine or not. Decimal may take up to 2 units. Okay, now let's see. Yeah, what he has done? Firstly, cash inflows after tax. He has done cash inflows after tax, because what is the formula for NPV, guys? What is the formula for NPV? You have to calculate, no? So in this table we are going to calculate, like you are going to subtract the inflows minus outflows. You are going to do that. So see, these minus in the brackets one, these are the outflows, and with the positive one, the all this profit after tax, salvage, these are all the cash inflows. So that's why they are in the positive thing. So we'll do subtraction, like cash inflows minus cash outflows will do, so that we'll get the NPV. If it is positive, we are going to replace it. If not, then we are going to use the same old machine. So for that we need cash inflows or not? Cash inflows, we are getting cash inflows. So let's see the cash inflows after tax. He has given in cash flows after tax. Yes. Now current production units per week. How much the old machine is there now? How much can it process per week? 5,000 units it can process. Now what new machine can produce? It can produce up to 15,000 units per week. Although its capacity is 15,000 units, how much is the demand, guys? Only 10,000, no? So it can produce 10,000 or 15,000. I already explained you. It can only produce 10,000 because the extra 5,000, although it has the capacity of extra 5,000, it can't produce is because they don't have any demand. So only 10,000 units there is demand. No, only 10,000 units it can sell. So what is the increase? From 5,000 to 10,000, what is the increase in sales? 5,000 units. And we know the contribution per unit, which is 3,000. How? I already told you while explaining the question here. Each TV sells for 30,000 rupees, which is sales value, and PYB ratio is 0.10, which is 10%. So contribution by sales is 10%. That means 10% on 30,000, which is 3,000. That is 3,000 rupees per unit, per TV unit. 3,000 is the contribution. So contribution per unit is 3,000. So now increase in contribution how much? This is 5,000 into 3,000, which comes to, so it is 5,000 into 3,000. We want it for per week or for whole year, guys. So for the whole year we are going to do, no. So 5,000 into 3,000, which comes to 15 crores. But they are going to operate in 56 weeks in the year. They said no. So into 56 we are going to do. Okay, 56 we are going to multiply with. So here comes 15 crores into 56, it is 84 crores. So this is the increase in contribution when compared to the old machine. So now we have to reduce the fixed cost from the contribution to get what is contribution minus fixed cost? It is profit. So we are going to calculate the increased profit, or only increased profit, because from the old machine, if we replace the new machine, what is the increased profit, increased contribution, increased fixed cost, like that. Okay, now we have that. Now that we have the contribution 84 lakhs, and you are going to deduct the fixed cost, additional fixed cost. How much? I already told you there is increase in fixed cost by 10 crores, right? So comparing to the usage of old machine, there is now increase in fixed cost of 10 crores. So we are going to deduct this 10 crores. Now the increase in profit comes to 74 crores. But we cannot directly take this as profit because there is 40% of tax here. So tax percentage, they have given 40% rate. So now we are going to deduct this tax. Now profit after tax is 44.4 crores. This is the cash inflows after tax, guys. So profit after tax. Now that we have this, we are going to now calculate the tax shield due to depreciation. Now we have the depreciation, no, 25% they have given in the question. Now we are going to calculate how much. So depreciation rate, they have given 25% for both taxation and accounts. Now what is the tax shield due to depreciation? Now we are going to calculate. See here, 100 crores worth machine is there. New machine cost 100 crores. So what is the depreciation, guys? 100% into 25%, which is 25 crores only, no? So 25 crores. For this 25 crores, what is the tax shield? I mean, what is the tax? 25 crores into 40%. If you do 10 crores, it comes to. So tax shield is 10 crores. We are not paying this tax, no. This is tax shield, guys. So due to depreciation, the tax shield is here. We are going to calculate the total tax. Okay, so on 25%, on 25 crores depreciation is 25 crores only, no. 100 crores into 25%, which comes to 25 crores is the depreciation. On this 25 crores, we are going to apply 40% of tax. This 10 crores is tax shield. But here they have given something called, where is this? Yes, After tax cost of capital, I already told you, this is PV factor discount rate 20%. So for all the 5 years, depreciation is only calculated once in a year, or for the whole 5 years, guys. Till the end of 5th year, he said no, for the 5 years. So first year depreciation is 25 crores. For all the 5 years, we are going to do no. So we have to take this PV factor, okay, at the rate 20%. Now for the first year, if you do it, 1 divided by 1 plus I whole power, and you know this formula. So 1 divided by 1 plus, what is I, guys? It is 20%. So 0.2 whole power 1. If you do this, you get 0.3. So 10 into 0.3, 8.3 you get. And for the second year, if you do 25, WDV method, no. So if you do straight line method, you always get the same 25 crores for every year. And but this is WDV method, no. 25 minus 25 crores minus 25%. If you do, you get this 18.75. And what is the tax, guys? 18.75 crores into 40%. If you do, you get 7.5. And what is the PV factor for this second year? 1 divided by 1 plus I. What is I, guys? 0.2 whole per what you do? 2, because for the second year, no. So if you do that, you get 0.69. If you multiply this 7.5 with 0.69, you get 5.18. And you do the same with 3, 4, 5 and 5th. For the 5 years, you do the same. You do 18.75 minus 25%, and you apply the same tax rate, that is 40% you apply, and you do the PV factors and you multiply the same, you get this. So what is the total for the all 5 years, which is 20.07, right? Now what is the tax shield on capital loss? So how this 23.73 came? First, what is the purchase price of this new machine? 100 crores, they said. So at the end of 5th year, what is the current value? What is the, at the end of 5th year, what is the value of that machine? So 100 minus 25% minus 25 minus 25, you are going to do for the all 5 years, and at the end of 5th year, you are going to get the value of that machine. What is the value of that machine now, which costs 100 crores? After 5 years, what is the cost? 23.73. You do in the calculator 100 minus 25 minus 25% minus 25% till 5th year. After 5th year end, what is the price? What is the current value of that machine? It is 23.73. But here, where is this given? So yes, the new machine is expected to have the salvage value of 20 crores. If that machine actually cost 23.73 at the end of 5th year, and its salvage value is 20 crores. So that is a loss or gain, guys? It's a loss, because that actually values 23.73 crores, and we're only getting only 20 crores, which is a loss. So we are going to apply the capital loss, which is 30%. It's a standard rate, no? So we get the capital loss of 1.12 crores, guys, right? Yes. Now we are going to calculate the NPV and decide whether the company can replace the machine or not. Now, okay, now in initial investment, guys. Initial investment, which is a 0 year, that is currently now, right now, the investment is 100 crores, which has a PV factor of 1, which means 100 crores outflow. So for the outflow, we are going to put the brackets. Now working capital, 3 crores are required, no? So which has a PV factor of 1, which is a 3 crores. Again, it's a outflow. We are going to put it in the brackets. So for the whole 5 years, during this 5 years, we are going to get the profit. Okay, so first year to 5th year, we are going to get the profit of 44.4. How, ma'am? We have above calculated it. You please see it. And what is the PV factor, guys? So we are going to add all this. 0.83 plus 0.69 with 0.58, 0.48 and 0.40. We are going to put it all together. You get this 2.99. So we are going to multiply this 44.4 into 2.99. We get 132.76. Now what is the salvage value after the 5th year end, guys? Now only we have read, no, at the end of 5th year, 20 crores is the salvage value. So what is the PV factor, guys, at the end of 5th year? Here only, no, at the end of 5th year, what is the PV factor? 0.40. Now this is the this is the PV factor. Now we are going to multiply this 20 into 0.4. We get 8. This is a cash inflow or outflow? Salvage value, no? So inflow. Now Here we have calculated the tax shield on depreciation or not for the whole 1 to 5 years. 20.07 we have already done in the table, no? So what is the total for the all 5 years? 20.07. Now tax shield on capital loss at the end of 5th year we have calculated, no? At the end of 5th year, after all the depreciation, the value of the asset, means the new machine, is 23.73. So now at the end of 5th year, it is 23.73. And what is the salvage value at the end of 5th year, guys? We are going to get the cash inflow only 20. So on that we have done, no, tax shield on capital loss. So what is this? We get into 30% we have done, that is the standard rate I said. So 1.12 into, we are going to do this PV factor. But here there is no PV factor, no ma'am. Why? All the table including everything we have done, no. So that's why here there is no PV factor and all, because for the from 1 2 3 4 5 all the years we have done together, no, including PV factor, and we have added all the things. So that's why here there is nothing. So 5th year 1.12 into PV factor we are going to do this. So it gets 0.45. And now the release of working capital. Here he says, where is this? Okay, now it requires a working capital of 3 crores, 3 crores, which will be released at the end of 5th year. So anyways, working capital means incurring of daily expenses, right? So anyways, the release is going to get at the end of 5th year, but we are going to incur, no. So that's why we have taken here working capital at the 0 year itself we have taken. So that is the outflow, but we are going to get that release of working capital at the end of 5th year, that is 3 crores. What is the PV factor at the end of 5th year? 0.4. We are going to multiply and we are going to get this 1.2. Now what is NPV? You add all the outflows and you are going to subtract the inflows. You are going to get a total of 59.47, which is a positive one. So if NPV is positive, can we proceed with this? Yes, a big yes. And if it gets negative, no, we are not going to replace the new machine, and we are going to continue with the old machine itself, because NPV is negative, no. So since here in the question we have got the NPV as positive, so the company is advised to replace the old machine, since the NPV is positive. Positive is good or bad? Good only, no. So yeah. And now here in the B bit they have asked to write a short note on cutoff rate. So it's just a theory one. You please read it carefully. You can get to know what is cutoff rate and all. Now we are going to look at the question number 3 A part. Okay, now let me zoom it. Okay, so Ram Limited evaluates all its capital projects using discount rate of 16%. What is this? All of its capital projects using discount rate? This might be weighted average cost of capital, no. So all its capital projects means, so WCC 16%, and its capital structure consists of equity capital, retained earnings, bank term loan, and debentures redeemable at par. Debentures redeemable at par means, it is redeemed at par, which is a face value. So maybe if we assume the face value of the debentures as 100, so it is going to be redeemed at 100 rupees itself. Now what is the rate of interest on bank term loan? Is 1.4 times that of debenture. So what is the interest rate on bank term loan is 1.4 times that of the debenture, he says. Now remaining tenure of debenture and the bank loan is 4 years and 6 years respectively. So for the debentures, after 4 years it is going to redeem, and what is the tenure for the bank loan, guys? It is 6 years. Now they have given the book values of equity share capital, retained earnings, bank loan and all. So 20 lakhs, 30 lakhs and 20 lakhs respectively. Now debentures which are having book value of 30 lakhs are currently trading at 98 per debenture. So what is this currently trading? 98 rupees. So if the net proceeds, if we sell this debenture right now in the market, we are going to get 98 rupees. So these are the net proceeds. 98 rupees is the net proceeds. Now the ongoing PE multiple for the shares of the company stands at 4. What is PE, guys? Price earnings ratio stands at 4 rupees, which is price earnings ratio. You remember the formula? MPS by EPS. Market price per share by earnings price, which comes at 4. Okay. Now what is required? You are required to calculate the rate of interest on bank loan and rate of interest on debentures. Okay, so let let's go to the answer and see what they have done. Okay, so there is a working notes. So they have given in the question, no, where is this? Yes, rate of interest on bank term loan is 1.5 terms of the debenture. They said no, so they have started with that. Let the rate of interest on debenture be x and rate of interest on loan, it automatically is 1.4 times of x, no? Yes. Now you remember the formula of debentures. What is this? KD on debentures, interest into 1 minus T plus RV minus NP. What is RV? Redemption value minus net proceeds by N, which is number of years, and RV plus NP, which is redemption value plus net proceeds by 2. This is the formula, isn't it? You remember, formulas are really important, guys. You need to thoroughly know about all the formulas. Okay. Now, if the interest is 100 rupees, okay, let's assume that interest is 100 and 1 minus T. What is tax, guys? Here they have given tax rate applicable is 30%. So 1 minus 0.3 plus what is redemption value? I already told you, at par means at face value, which is 100, and net proceeds, it is currently trading at 98, no? So the net proceeds is 98 rupees. Now what is N? What is the tenure of debentures, guys? 4 years, no? So divided by 100 plus 98 by 2, which comes to 70x plus 0.5 by 99. Now what is KD on bank loan? 1.4 times of x, no? What is x? What is x, guys? Here, rate of interest on debentures. Rate of interest, it is not interest on debenture is x. It is rate of interest on debenture is x. Now what is rate of debenture on x? This is x, no? Interest on debentures, rate of interest on debentures, how much? 100 into 1 minus 0.3. The rate means divided by 100%, no? So 100 get cancelled. And now what is x, guys? 1 minus 0.3. So 1.4x, no? 1.4 into this is x, because rate, no, divided by 100, again 100 gets cancelled, and now this is 1 minus 0.3. If you multiply this, you get 0.98x. Now that we have KD on debentures and also KD on bank loan, now they have given something. What is this? PE, multiple for the shares, stands at 4. They have given, that is PE they have given as 4, that is price earnings ratio, which is MPS by EPS. So what is KE, guys? Tell me the formula of KE, cost of equity. EPS by MPS. So in order to understand what I am teaching, you have to know the formulas. So what is KE? EPS by MPS. So if we take this 1 by MPS by EPS, because why we have to take in such a way, ma'am? Because they have given about PE, they have not given about all this. So we have to arrange in such a way so that we can arrive at PE. Now we are going to do 1 divided by MPS by EPS, that is 1 by PE, which is 1 by 4. 1 by 4 means 0.25 only, no? So KE is 0.25. We got it, no? Now let's calculate computation of WACC. We already know what is WACC. They have given all the capital projects, the discount rate is 16%. They have given. We have to know what is X. So that's why we are going to take this, consider the table. Okay. Now, the capital structure they have given. Their capital structure consists of all this, it seems. What is that? Equity share capital, retained earnings, bank term loan, and debentures, it seems. All these 4 they have. So equity, retained earnings is nothing but reserves, debentures, and bank loan. All this they have. They have given what is the book value of all those. They have given in the question itself. So don't worry. Okay. All this are they have given in the question only. These are the book values, it seems. Okay. What is the total? 1 crore total. So according to the total, you have to put on the weights. What is 20 lakhs upon 1 crore? It is 20%, no? What is 30 lakhs upon 1 crore? 30%, and this is also 30, and this is 20, which comes to a total of 100%. So are going to take 0.2, 0.3, 0.2, 0.3 and 0.2. Okay, these are the weights only. So now we have to multiply the weights with cost only. What is weighted average cost of capital? Weights into cost of capital. For all the capital structures you are going to do. And now see what are the cost, guys. Equity, just now we have find it out. So what is KE? 0.25. Just now we have done, no. And what is the cost of equity? That only the cost of reserves also. KE equals to KR. You read, no? So for the reserves also it is 0.25. What is the cost of debentures, guys? Here. Yes. KD on debentures. What is this? 70x plus 0.5 by 99, no. And what is KD on bank loan? So here KD on bank loan is, 0.98x, no. So we are going to put this cost of debentures and cost of bank loan here. So 70x plus 0.5 by 99. And what is cost of bank loan, KD on bank loan, it is 0.98x. So we are going to multiply this weights and costs. 0.2 into 0.25, it is 0.05. 0.3 into 0.25, it is 0.075. And now we are going to multiply, 0.3 into this one, we are going to get this. And 0.2 into 0.98, we are going to get this. All this, if we add this all, WCC means, so this all. So what is 0.05 plus 0.075 plus 0.0196 and this 121x plus 0.15 divided by total 99. All this we are going to add. This one, 16%. WCC is 16%. How, ma'am? Here they have given all its capital projects using discount rate of 16%. So all the capital project means, for all these, these are the capital structure, no. It is the capital structure and these are the all the capital projects that are there in the company. So for all that, discounting rate is 16%, they have told you. So now put it in the equation. 0.125 plus 0.196x plus 21x plus 0.15 divided by 99 equals to 0.16, 16%, no. Now we are going to take this 99 as LCM. 99 into 0.125, we get 12.375, and the same 99 into 0.196, we get 19.404x. and now this is the same because the denominator is 99 itself for that. So 21x plus 0.15, so this 99 goes there, so 0.16 into 99. Now if we solve this, you solve it, you get the x value as 8.20%. Now what is x, guys? That is rate of interest on debenture only, no. We got the x as 8.20. So with the help of x, can you calculate a rate of interest on bank loan? Because it is 4.x, no. So 8.20 into 1.4, we get the rate of interest on bank loan as 11.48%, right? Now what they have asked, it is a small bit, guys. Discuss the dividend price approach to estimate the cost of equity capital. So for the purpose of calculation of KE, discuss the dividend price approach, it seems. So dividend price approach is one of the methods to calculate the cost of capital of equity, KE. This is one of the methods. In the name itself, dividend price approach. In the name itself, we should know the formula because it is very simple formula. Dividend price approach, which is to calculate the cost of equity, which is KE. So what is dividend? D1. D1 is what? Expected dividend, but D0 is current dividend. So dividend price approach is an approach which is used to calculate the cost of equity by expected dividend by market price, by dividing the expected dividend by market price. So D1 by P0 is the formula. Isn't this formula simple? Because in the name itself, dividend and price approach. So dividend is expected dividend and price means P0. So here they have given where KE equals to cost of equity, we all know that, and D is, so D1 is dividend, expected dividends, also D is expected dividends, also written as D1, it seems. So P0 is market price of equity, obviously, so X dividend, right? So this is the dividend price approach. And fourth question is a theory question, guys. So please you first concentrate on the practical questions because these are very important, and if you have time, you prioritize yourself with theory questions. And I hope you understand. I have now completed with this mock test March 2024 series. If you have any doubts, you can ask me. I'll always be there for you. And please subscribe to my channel, guys. Thank you.